Inflation has eased with the annual consumer price index for December pulling back to 5.1%. That's from November's 5.5%. Now, this was thanks to moderation in fuel prices. And today's print also wraps up the data for 2023 and showed that the average inflation rate for the year slowed to 6% from 2022's reading of 6.9%. Joining us to take us through this print in greater detail is Chief Economist at Stanlib, Lings. Kevin, thank you so much for being with us today.
Thanks a lot. Thanks for the invite.
All right, given a 5.1% in the month of December, which I think is usually known as a month where many people come out to spend, I'm keen for you just to contextualize this number for us.
Yeah, it is. It was certainly a surprise on the downside, a welcome surprise, obviously. It's not a particularly high survey month. In other words, Stats SA doesn't measure every single category every single month, and December is not a particularly high survey. But importantly, I thought food inflation unchanged in the month. Now, if you go back to October and November, we saw some big increases in food prices. We were obviously worried about the poultry industry that was feeding through into some food inflation. But in December, the number dissipated substantially. And so I would say that was a big factor, certainly helping to surprise on the downside. The petrol price coming down, we knew about that. There's another petrol price decrease that's still going to be factored into the January numbers. Unfortunately, if I look at February, we're likely to have a petrol price increase, probably around 50 cents a litre. So we're gonna claw back some of that then. But for the moment, I think the fuel price is very helpful. And then if I look at the other categories, not a lot of inflationary pressure around, and that should please the Reserve Bank when they meet this week.
I must ask you though, what would be seeing here? The milk, eggs and cheese price index increased 14.5%. In my mind, I thought this is school holiday food. But I'm keen to get your thoughts on that, and what we're seeing here. Is that still, the poultry industry is, and most of it, some of it?
Sure. So if we've got some high numbers. It's not just that category. There's a couple of other categories where we've got double-digit inflation rate in terms of the annual rate for some of the food components. Obviously, if you look at oils and fats, that number has declined, and that is kind of off a high base. So I suppose in that sense, it's not surprising. I think what matters enormously is what's happening to the monthly increase in some of these categories, and we've seen some moderation in pressure. Overall, though, food inflation is up at over 8%. That's way too high. It's a big part of the basket. We see it impacting particularly low-income individuals substantially. So it's not as if you would be comfortable with the number where it is now. But where we're a bit more encouraged is not long ago we were talking about an El Nino effect disrupting our weather pattern. That doesn't seem to be playing out. We were worried about some global pressure on food prices. That's not really playing out. So it feels a bit more encouraging. And if I look at agriculture inflation, those numbers have also dissipated, suggesting that the pipeline of food production is seeing slightly less pressure.
I want to also talk about the core number here. That's around 4.5%. We hear of this 4.5% number quite a bit, but the Reserve Bank wants to see headline inflation at 4.5%. Hey, Kevin, it's not good enough for core to be at that number.
Yeah, so it's been below 5% now, I think, for 6 months. That's a decent outcome. It's suggesting that the underlying level of inflation is under control, and we've got some high numbers, right? It's not as if every level is low. If you look at education inflation, healthcare, water, electricity, there are some big inflation numbers, but the core number does provide comfort, suggesting that we don't have a build-up of broad-based inflation in South Africa. And 4.5%, I think, is pretty much the best we would expect under current circumstance. So I think that will be comforting also for the Reserve Bank. In terms of the headline number, you would expect the Reserve Bank will want to see a little bit more of a downward trend, but we're clearly moving closer to the point where they would be considering a cut in interest rates.
I must then ask you, going into the MPC, the meeting starts today. I think we get an outcome tomorrow, Kevin. What concerns me at this point is the global environment and how that could feed into the local environments. And I'm wondering, with quite a hawkish committee there that sits, how do we make sense of how they will try to take in what's happening around the world?
So I think the global environment matters enormously to our decision making, probably more than the Reserve Bank is willing to admit. I think they pay a lot of attention to what's happening in US and in European interest rates. And if you look at the information coming out of the United States, inflation surprised a little bit on the upside. There's a little bit renewed concern that you've still got work to do to get inflation fully under control. Europe, the inflation rate, yes, it's getting to the target, but it's not there yet. And so the message from the Federal Reserve and the European Central Bank is that they're not yet ready to cut rates. And it's quite risky for South Africa to embark on an interest rate cutting cycle while the US is keeping rates elevated. It's not impossible. It's not something you can't do, but it increases the risk. And if you look at where the currency is at the moment, I don't think the Reserve Bank wants that additional risk. So from their perspective, given global circumstances, given what's happening to geopolitics, the disruption in the Suez Canal, that could feed into some inflationary pressure down the line. I think the Reserve Bank will still be conservative, signal that, yes, they're happy with the progress so far, but they're not yet ready to cut rates, and perhaps get past the immediate concerns around shipping activity being disrupted because of the conflict in the Middle East.
Well, Kevin, it's all we have time for today. Always a pleasure catching up with you. Thank you so much for taking us through this print. That was Chief Economist at Stanlib, Kevin Lings.